go. So again, let me introduce Tony to you. Tony, I known Tony for about 7 or 8 years now. He's a real estate investor himself, and he is expert when it comes to taxes. He actually helps me with my personal tax return as well as my corporate. And when it comes to real estate and small business and taxes, Tony is the man to go. So I send all of my clients to Tony, and he is expert, and he has a great presentation that he will share with you, and he will explain what certain things that you need to look out and do before the end of the year, before it's too late, because you still have the time. And that's why we do this kind of events, because we want you guys to actually be proactive, and we want to educate you, so you have time to make some changes, some adjustments that will result in perhaps significant tax savings for you. So Tony, take it away.
Great. Thank you so much, Dimitri. Welcome, everybody. Once again, my name is Tony Watson. I work for Robert Hall & Associates. We are a full-service tax consulting firm based in Glendale, which is a little bit east of downtown LA. I've been in the business for going on 10 years now. Robert Hall & Associates has been around for about 43 years. And tonight's topic that we're going to touch on, one of many topics that I like to cover before December 31st, is the benefit of effective year-end planning and the importance of understanding your tax situation before December 31st. And I actually gave the seminar last month, so forgive the November 2014. I should have changed that, but you know, it's never too late as long as it goes on before December 31st. So here's a picture of our building just to give a little background as to who we are and what we do. We've been around since 1971. We've been a leader in the tax preparation industry. We help small businesses, real estate investors, firefighters, police officers, teachers, basically anybody who files a 1040 tax return or a corporate tax return. We help them with the structuring from the ground up. We do tax structuring for investors, agents, brokers, developers, and property managers. And we help our clients with tax preparation, tax structuring, audits, and incorporating services. So if you have any looming questions after the seminar tonight, you can either visit our website, roberthalltaxes.com, or you can contact Dimitri with Sense Financial, and he can route you over to our office to get those questions answered for you. All right. So to get started tonight, first topic, we're going to talk about why is it important to know my tax situation before the end of the year. Well, for a number of reasons. You know, there really isn't one reason that we're going to focus on tonight, but as of December 31st, you know, the clock, once the clock strikes 12:01 a.m. on January 1st, and we're all celebrating New Year's, there's really very little that anybody, including myself, can do for you in the way of significant tax sheltering strategizing. You know, as of December 31st, all 401ks, all tax-deferred accounts except for maybe a SEP IRA type account will need to be at least set up before December 31st. Some accounts may not need to be funded before December 31st, but they do have to be set up and ready to be funded. Now, the way that a 401k works, for instance, either a solo 401k or a regular 401k, is that account not only has to be set up before December 31st, but it also has to be funded by December 31st, because that is an individual contribution to an individual tax-deferred account. You know, as far as a SEP IRA is concerned, you can have the account set up before December 31st, but you might not have to fund, let's say you're putting $20,000 into a SEP account, you don't have to fund it before December 31st. You can actually fund that before April 15th, and if you're on extension, that buys you another 6 months up to October 15th to fund that account. Now, the main reason why you want to focus on your tax situation is to make sure that you're not overpaying or underpaying Uncle Sam. Now, one thing that I've always preached to my clients is that if you overpay Uncle Sam, sure, he will refund you that money. However, if you overpay him on a quarterly basis or over 365 days, you're essentially giving the government an interest-free loan, because when they pay you back that money in your refund, they a lot of times won't even pay you interest unless they've held on to your money for a substantial amount of time past the October 15th deadline. And trust me, the interest is nothing to be excited about. So I would much rather my clients focus on a break-even scenario, meaning that as of December 31st, they've covered all of their obligated amount of tax, and they haven't overpaid or underpaid Uncle Sam. Now, when I say obligated amount of tax, I mean that every taxpayer has an obligated amount of tax to pay. and we can effectively plan to pay that obligated amount and not a penny more than the obligated amount. So as of December 31st, you need to pick up the phone and call your tax preparer, either CPA or EA or CTEC certified preparer. If you're in different states, I see we have a couple people from North Carolina, and we've got some from Philadelphia. I'm in Los Angeles, live in Pasadena. So it doesn't matter where you are in the U.S., picking up the phone and calling your tax preparer and getting that planning in before December 31st could not only save you a couple $100. I mean, we're not talking about the dollar savings. We're talking about thousands and thousands and thousands of unnecessary tax that did not need to be paid as long as you do the proper tax planning. And that all has to be done before December 31st. Now, sure, you can contribute money into a Roth account. You can contribute money into a traditional IRA account, and that can all be done in the new year. However, you do need to set up those accounts before December 31st to make sure that they're ready to receive the funding of the tax-deferred amount. Roths, for instance, are not tax-deferred contributions, but they are good if you are filing currently in a low-income bracket. And the way that those Roth accounts work, whether it's a Roth 401k or a Roth IRA, is that every dollar that you put into the Roth retirement account, ROTH Roth account, it's already paid tax. And so let's say that I put $5,000 into a Roth account and it grows to $15,000. The whole benefit of a Roth is that if I draw that $15,000 from the account at the age of 59 and a half or older, I don't have to pay a single dime of tax, including the 10% early withdrawal penalty. I don't have to pay that because it is a Roth account and I've already paid money on the original $5,000 contribution. Whereas the 401k and the traditional IRAs are completely different. They're the exact opposite. That money that you're funding into that retirement plan has never paid a single dime of tax. And so at that moment, when you contribute that money, it is fully tax deferred and it is a tax write-off to you as an individual. Now, once again, we're looking for the tax benefit in 2014 right now. So a lot of what I am handling in my office is meetings with clients, deciding whether or not they should go out and purchase a new vehicle as a corporate asset so they get the accelerated depreciation write-off in 2014. Or if a client hasn't fully funded their solo 401k before December 31st, whether or not they should max that contribution out and be almost like retirement rich and maybe a little bit cash poor, or find that sweet spot to where we don't put all of their cash into their retirement account and make it so that they're living from paycheck to paycheck. We have to find that sweet spot. And so that has to be done before December 31st. So moving on, we're going to touch a little bit on the W-4 review and how do you determine the exemptions that you should be taking on your paychecks. If you are a W-2 wage earner, meaning that you are either a part-time employee, a full-time employee, not an independent contractor, not a person who is considered to be self-employed, if you actually work for an individual or a company that pays you a W-2 wage, the W-4 review is something that you can definitely take advantage of in the last quarter of every year. Now, you should be reviewing your W-4 throughout the year, especially if you have significant changes that are being made to your financial situation. One example is, let's say you get married in 2000, or you got married in 2014. Each individual who is working, if both the husband and the wife or the spouses are working, if both of them and each person has a stream of income, you might want to review your W-4 exemptions to make sure, once again, that you're not overpaying Uncle Sam. Because in most cases, when you switch from a single filing individual to a married filing joint filing of a return, you're going to be put in a better income bracket, and the withholding of single zero, for instance, single zero or single one on your W-4 might be withholding too much. And so you'll get this huge refund at the end of the year, but remember that the refund is just your money that the government's giving back to you. It's not the government paying you for being a good citizen, so to speak. That would be kind of silly. I wish that was the case, but definitely isn't. So the W-4 review is to review the amount of withholding you have from each of your paychecks. Now, the way that we go about doing this is we take, for our current clients, we take their last year's tax return and we figure out what their liability was based, or refund was, based on how much they paid into the system or how little they paid into the system, and based on what changes were made throughout the year, if a home was purchased, or if they decided to max out their 401k, or if they lost a job halfway through the year, they're going to have a significant amount less of income. Those are some pretty big changes, and so why would you continue to pay the government withholding if you're currently not working? Now, this is specifically important for the self-employed individual who's making estimated tax payments. You do not want to continue with estimated tax payments if your business is not making any money or if it's at a break-even scenario on a quarterly basis. So the W-4 review is to make sure that you're not overpaying, to make sure that you're not underpaying Uncle Sam. And the way that you determine these exemptions, if any of you have ever filed a W-4 review with your employer or your payroll department, you know that there's a calculation on that Form W-4. Now, that calculation, about 9 out of 10 times, is not going to be correct. And the reason why I use 9 out of 10, I haven't actually done that statistic, but the reason why I say 9 out of 10 is because a lot of times when a client fills out that W-4 without understanding how and why it's withholding a certain ratio from your paycheck, you might not be withholding enough based on your particular tax scenario. For instance, if you go to work and your coworker says, well, I'm claiming single 4, you should claim single 4 too. We have 2 kids, we're married, we have homes, you should be claiming the same thing. Well, sure, I mean, you might actually be claiming the same thing on your W-4, but there are moving parts in that scenario. And so if you jump to the conclusion that single 4 would be the right thing for you, you might end up either owing the government or significantly overpaying based on your particular tax scenario. So be very careful of who you receive and adhere tax advice from or even giving tax advice to. Be very careful with that because it could put you in a very sticky situation. Now, once again, the determining of the exemptions is almost a good calculation on the W-4 that you can go through. However, I'll give you a specific example. If I'm a single guy and I'm working a W-2 wage earning job and I'm making $50,000 a year and I don't have children and I don't own a home and I file with the standard deduction, that calculation on my W-4 may be correct. Now, let's say that I get married and my spouse and I purchase a home and we have a child. And we have a really, really busy year, and all of that happens within 365 days. A lot of things have changed our scenario, and let's say that my spouse is not working. Well, if I file married filing joint on my W-4, what I'm telling the government is that I am married with a spouse and I am in a particular tax bracket with a certain amount of children that I'm claiming on my individual tax return. And so the married for M4, M3, or M2, or M1, that's essentially going to withhold based on one stream of income, one revenue source, meaning that I am the only individual that's working at the moment. However, if my spouse also starts working and we are married and we have 2 children and she also claims married for, because married for would include myself, my spouse, and my 2 children, 4 exemptions. If she also claims married for, it's going to withhold a very small amount because once again, the calculation is assuming that she is the only person in the relationship working. So we're going to file in a lower income bracket. A lot of times what will happen is when you add those married for W-4s or those married for M4 withholding paychecks together, it will bump you and your spouse into a higher income bracket with less withholding. And so this is a very, very important review. The reason why I went into so much detail right there is because this W-4 review is very, very important, and it only takes maybe 10 to 15 minutes with your preparer. It shouldn't be an extensive review of your tax situation. I mean, if you want to go into more detail, by all means, call your tax preparer. But this W-4 review a lot of the times can be done by phone, and as long as we have a prior year return to review to show what exactly your deductions were from the prior year, and we get a little template going to make sure that our estimates are as accurate as possible. So as far as how you determine the exemptions, I wouldn't suggest for you to determine them unless you are a single filing individual without a home, without children, just filing on one source or revenue stream. If you are married, if you've had a child within the last couple of years, if you have a home, if you're investing money in certain things that are deductible for you on your return, you may want to sit down or call your accountant and have him review those exemptions to make sure that they are correct and it is withholding enough to cover your individual liability. Deductibility of mortgage interest. This is one of the most common questions that comes across my desk, whether or not acquiring debt for tax savings is a good thing, and how it is a good thing, and how much does it actually save you. Well, when you talk about owning a home, you talk about having either a fully paid off investment or you have debt attached to this property, which essentially is a portion of it is a tax write-off. Now remember that if I own a home and I'm financing it at $400,000 and I have a $400K loan attached to that property, that the principal is not tax deductible. The interest is, however. And so what will be tax deductible for me is the interest I am paying on that $400,000. Now, a lot of people think, okay, well, why would I not opt to have more interest on my loan? Let's say a 6% rate. I know this is a silly example, but you wouldn't believe me if I could tell you, if we could sit here all night and I could explain to you how many questions like this I get on a weekly basis. Would it make more sense for me to have a 6% interest rate rather than a 4% interest rate for the tax savings? Absolutely not. In fact, if you were all sitting in a room with me, I would be preaching to you living a debt-free life is the best and most efficient way to live. I believe in paying off assets as quickly as possible because that's the only way that I truly can receive 100% positive cash flow. I follow that rule. I preach that rule, but at the end of the day, I do know that if I do need debt to acquire an asset like a property, that at least I'm going to be able to shelter that mortgage interest write-off on my return and save myself from paying a little bit of federal and state tax. At the end of the day, the mortgage interest write-off is only going to save you what individual bracket you file under. Meaning that if you file in the 33% tax bracket, or let's say 15% tax bracket, and somebody else files in the 33% bracket, you individually in the 15% bracket are not going to save as much tax as the individual in the 33% bracket who owns the home and pays interest. Remember that your deduction is going to save you the amount of tax based on the rate of tax that you're paying or whatever effective tax rate you file under. So at 35% in federal tax liability, every dollar of interest that I pay, I'm going to save 33 cents to 35 cents per dollar, which is a pretty significant tax savings. Hang on one second. We have cleaners coming through our office, and I didn't want the vacuum to be too loud. So the mortgage interest write-off, once again, it's not going to save you exponential amounts of tax. In fact, it is not even what's considered a dollar-for-dollar tax write-off. Once again, every dollar that you pay in interest is going to save you an average of between 25 to 30 cents, depending on what state you live in. Here in California, we have a 9.3% tax rate. It can go upwards of 13% sometimes for high income earners. And at that point, once again, you might be saving a little bit more because you're paying more tax or paying at a higher rate. And so every dollar of interest that you pay is going to save you effectively whatever tax rate you're in. But at the end of the day, it's never a good thing to have over-leverage yourself with property. Once again, I'm a believer in real estate. I'm a real estate investor myself. So whatever it takes to close on that deal, I will do. And I do know that I'll never take a higher interest rate just for the tax write-off. I'll always opt for the least amount of debt as possible because my number one goal, is to pay off that property as quickly as possible. Even though, I'll give you an example. Let's say that I walked up to you on the street and I held out my two hands and I said to you, hey, you have to choose one option. And I'm holding out my two hands in front of you and I said, you have to choose one of these options. You can either give me 75 cents, put 75 cents in my left hand, or you could put 25 cents in my right hand. Your options are, and you have to choose one, no matter what, that you can either give me 75 cents or you can give me 25 cents. The obvious answer, if I asked you what you would rather choose, is to give me 25 cents because you're choosing to give me less of your money so that you can keep the 75 cents in your pocket. Well, that's how the mortgage interest write-off works is, sure, for every dollar of interest that you pay, you're going to save 25 cents in tax. But the sooner you pay off that property, you might pay 25 cents per dollar in additional tax, but at least you're pocketing the 75 cents and not having to pay Bank of America or Wells Fargo or Chase or whoever you're leveraging your money through. And so that's the importance of focusing on paying off assets as quickly as possible, especially if you have your property in a solo 401k type investment. Now, you can have debt within a 401k for solo 401k to acquire property, but the whole benefit of a solo 401k is to have immense cash flow or as much cash flow as possible so that it's being reinvested back into a tax-deferred account, meaning that until you retire, all of your cash flow and all of the money that you're making from either flipping or renting property is fully tax-deferred until the day that you actually decide to collect on retirement. So make sure that you understand how debt works before you acquire too much of it. One of the main reasons why 2006 and 2007 happened and on to 8 and 9 with the real estate industry is the fact that people were promised these things saying that they could afford these massive homes on, smaller income salaries. and they couldn't afford the mortgage debt. They couldn't afford the mortgage payment, especially if the loan was to balloon and the interest rate was at 1.3%. Now it's at 10 or 11%. Of course, a person making $50,000, $60,000, $70,000 is not going to be able to afford a $700,000 home at that point unless they have massive savings or inheritance. So make sure that before you over leverage yourself, you understand the deductibility of mortgage interest. All right, carry forwards and NOLs. I don't want to get into too much detail, and I don't want to confuse people too much tonight, but these are probably two of my favorite words on a tax return. And by favorite, I mean I love to utilize these particular parts of the Internal Revenue Code to benefit my clients. Now, we'll start off with carry forwards to begin with. Carry forward essentially is exactly what its name entails. It's something that carries forward to future years. And so certain deductions that you have on your return, especially if you are a real estate investor, can either be carry forward losses or carry forward carry forward losses pretty much. You can't have carry forward gains, but you can accelerate gains to use against current year losses. And the way that a carry forward essentially works is, let's say that I buy into a stock for $100,000. I buy $100,000 in stock for a company. And let's say that that company goes belly up because of the recession, and I lose $100,000 in the stock market. Those stock losses become a carry forward loss until I have enough capital gain, until I have enough stock gain to offset the loss with. And so at that point, these carry forward losses are sheltered. And with stocks, for instance, you can only take, let's say I have a $100,000 loss, I can only utilize $3,000 in those losses per year until my $100,000 of losses is fully used up. Now that will carry forward until they're fully used up, or if I sell something with a substantial capital gain. So let's say that I have, 3 years of $3,000 losses, and that's $9,000, and now I have $91,000 of my $100,000 loss still left over. Well, $91,000, technically I could sell my Apple stock, let's say, for a $91,000 gain, and it would wash the gain out completely. I would pay no tax on the sale of that Apple stock because I had a $91,000 loss to offset the $91,000 capital gain. So there are ways to use carry forward losses to your benefit, and that is, once again, all part of year-end planning. I've had clients come in saying, hey, listen, I have hundreds of thousands of dollars in stock losses from bad investments I've made over the years, and I want to sell one of my rental properties. Because of this capital gain that I'm making through real estate, can I utilize my long-term losses from my stock investments? Absolutely you can, because capital gain can be from anything. Capital gain can be from selling property. It can be from selling stock. It can be from selling accessories in your business. It could be from selling cars. It could be selling anything with a capital gain. And so with that comes along the benefit of the tax code saying that as long as it is a capital investment, a capital gain or a capital loss, long term, it can be offset. And so that particular example, I've had to utilize that specific part of the Internal Revenue Code for my clients to save them hundreds of thousands of dollars in tax. If I have, $300,000 in carry forward long-term losses, and I know that my client's going to sell a property and make a $300,000 capital gain, why not dish the property out if they're already thinking about selling it in the same year that you can utilize these carry forward losses and save yourself from paying tax on $300,000. So all part of year-end planning, all part of tax planning. As far as NOLs are concerned, NOL stands for net operating loss. Now, a net operating loss is, once again, one of my favorite things to utilize on a tax return to save exponential amounts of tax. Net operating loss is essentially when your taxable income or your AGI, your adjusted gross income, is negative. So let's say that I had a $100,000 W-2 from a prior year, and then this year I was out of a job and I was collecting unemployment, but I still had all of my business losses carrying forward through my real estate investments. And at the end of the day, my $15,000 of unemployment was being offset with $50,000 in rental property losses. Well, at that point, I'm showing a $35,000 negative adjusted gross income because $15,000 of unemployment income minus $50,000 in expenses leaves me with $35,000 left of just overall adjusted gross income. At that point, if I have a negative adjusted gross income, that NOL, that net operating loss, will carry forward to next year. And let's say that I start 2015 with a $35,000 NOL. essentially what that means is that the first $35,000 of income that I make in 2015 will basically not pay any tax, because I'll have a $35,000 loss to offset the $35,000 of income. So NOLs will offset normal income, and it'll pretty much offset everything except for income subject to self-employment tax. So if you are self-employed, it will offset your income, but your profit through your business. Let's say that I have a $35,000 net operating loss carried forward to 2015, but let's say that in 2015 I was self-employed and I made $35,000 of independent contracting self-employed income. I will not pay any federal and state taxes on that $35,000 because the loss will offset the income. However, I will still pay self-employment tax on that $35,000. Well, self-employment tax is about 15.3%. 15.3%, half of it is tax deductible, so it comes out to about 7.65%. So you're still going to have to pay that, but at that point, you will not pay any federal or state tax. Carry forwards and NOLs, very, very important to sit down with your accountant to see if you have any of these current scenarios working for you on your return and how to utilize them to the fullest benefit in the current year. Now, do you have to make estimated tax payments? Well, for the self-employed people who are in the webinar tonight, if you are self-employed and you're making any sort of profit, the government is going to expect you to prepay certain portions of your liability. If you are a W-2 wage earner, if you're actually working as an employee of a company, you probably already have federal and state withholding from your paychecks. And so at that point, you don't really need to make estimated tax payments. However, there are still some instances where a client will be making a significant amount of income, and even though he or she may be claiming single zero and withholding the most, and he or she's thinking that they have enough taxes paid into the system to cover the liability, that may not be the case. At about $138,200, 138,200, an anomaly happens on a tax return for that considered to be wealthy individual. $138,200, I don't know about the rest of you, but in Southern California, it doesn't really buy too much in the way of investment property. Elsewhere in the U.S., it may buy a little more, but Southern California, it doesn't really go as far as we'd all like it to go. But at $138,200 of adjusted gross income, the government has the option, or not the option, but insert something called alternative minimum tax into your tax return. Now, for short, it's called AMT, and AMT stands for alternative minimum tax. Now, what AMT is it is a cap on the amount of deductions that you are able to take on your individual tax return. And so at that point, you could be making $200,000 of income and claiming single zero on $200,000 of W-2 wages and writing off everything under the sun as a tax deduction for you. But at the end of the day, a majority of your expenses will not be tax deductible because of this alternative minimum tax. Most people don't realize that, they always talk about there being a flat tax that will eventually be implemented by the Internal Revenue Service. In general, AMT is a flat tax. States don't have alternative minimum tax a lot of times. Other states may have small AMT calculations, but a majority of the people see AMT on their federal tax return. And so it is essentially a cap, a flat tax on the amount of deductions that you get to take as an individual tax filer. And so single zero probably won't withhold enough to cover the liability because you're not allowed certain deductions on your return. In fact, for most wealthy, if you could see my hands, I'm doing quote unquote wealthy individuals who make over around $175,000 of income. Most of those individuals will see alternative minimum tax pop up on their return. And at that point, the only three things that are tax deductible for those employees making $175,000, the only three things that are tax deductible are property taxes, mortgage interest, and charitable contributions. Essentially, those are the only three write-offs that you can take on your Schedule A as itemized write-offs. And so we all wonder why the wealthy donate so much to charity. They can donate up to 50% of their overall income. Well, it's because it's one of the only three deductions that they are allowed to take. And so that gives you a little bit of insight into how and why the wealthy do some things with their money. And it takes money to make money. And if you have a couple $100,000 of income per year and you decide to donate a lot of money, a good chunk, to a hospital, and they put your name on the side of the building, and that's good advertising, obviously. You're a good Samaritan. You've been donating a lot. Up to 50% of that person's income will be a full tax write-off on their individual return. So getting back to, sorry for the rant, but getting back to, do I have to make estimated tax payments? It really all depends on your individual scenario. Once again, if your neighbor is saying, well, you and I make about the same amount of income, I don't make estimated tax payments, so you shouldn't have to either. Do not take tax advice from anybody but a tax advisor, because they can make calculations for you to make sure that any liability whatsoever it needs to be covered before December 31st, and they can give you estimated tax payment vouchers. Now, the government has 4 opportunities to penalize you if you don't prepay your liability, or even pay it by the extension deadline, plus interest. So technically 5 ways that they can penalize you. Number 1 through 4, to start off with, 1 would be underpayment penalties. 2 would be estimate penalties, 3 would be late payment penalties, and 4 would be late filing penalties. And then we'll tack on interest, which is 5 different types of penalties that you can be hit with. Now, if you don't make estimated tax payments and you do have a liability come April 15th, the government will hit you with a couple things. 1, an underpayment penalty, 2, the estimate penalty, and then they'll tag on interest on top of whatever they're owed. If you file late, they will hit you with a late filing penalty, which is still just as bad. And in fact, the late filing penalty is the number 1 highest penalty that you can be hit with, which is kind of crazy. And so you want to make sure at all costs that you're avoiding these penalties by doing the proper planning before December 31st. The penalties, once again, our taxes, our federal and state taxes, and local sales tax and use tax, all of that goes towards something. It goes towards our education system. It goes towards paving our roads. It goes towards funding, public sectors and private, not private sectors, but public sectors, police force and the firefighting force and everything. That's where our tax dollars really should go to. But the penalties go to the IRS. The penalties is how, these assessed penalties is how the government makes money and how they can afford to hire more people and fund the pensions for these government workers. So the less and less we pay in penalties, the better off we are, because that's not going towards benefiting you at all. It's not going towards benefiting our education system or, once again, our public sectors in local areas or local government areas around where you live. So make sure that you're not overpaying the government or underpaying the government, but calculating that liability to make sure that you're paying your obligated amount of tax. That's what we're focusing on, the obligated amount of federal and state tax. So I throw this slide up here because this is another question that I get asked quite frequently, especially for the residents who are self-employed or real estate owners in California. Can you incorporate in a different state? As far as California is concerned, for the people who are in the room who are California residents, California has a very specific set of rules saying that if you are a California resident, you can incorporate in all other 49 states, but at the end of the day, if you individually are a California resident, you will still be subject to California state income tax, as well as the filing fees for each of the individual entities. Now, I know that New York is the same. New York taxes you on your worldwide income. California taxes you on your worldwide income. But there are still reasons for individuals, for the rest of you in the room who are not California residents, there are still reasons to incorporate in other states outside of the state that you live in. For instance, Wyoming, Delaware, New Mexico, Nevada, Alaska, states with great asset protection laws. Now, I am not an attorney, so I can't give you legal advice, but I can tell you that out of the states that you have to choose from, there is a select set of states, about 7 or 8 of them, that give you great asset protection benefits. Alaska happens to be one of the more popular ones. Delaware, Wyoming, New Mexico, I've heard, is great as well. Nevada just adopted the Series LLC, which allows you to set up 10 different LLCs under one filing fee in the state of Nevada, which is huge. But there are different states that you may want to shelter your assets in. As far as whether you are avoiding your individual state income tax or not, that's not something that you should be focusing on. You should be focusing on the asset protection benefit of incorporating outside of your state. And once again, you can incorporate in different states. It doesn't mean that you are going to avoid paying your individual state income tax. Now, getting to probably one of the most important parts of tonight's seminar regarding year-end planning is the 401k IRA versus self-directed IRA / 401k. Now, Dimitri with Sense Financial, like he had said, Dimitri and I have known each other for quite some time, and I've sent a lot of business to Dimitri as well as the other associates that I work with here at Robert Hall. Just to let you know a little bit more about Robert Hall, we have just shy of about 10,000 filings that we prepare per year. We file taxes in all 50 states. There probably isn't a scenario that we haven't seen. And if hopefully everybody's getting a lot of great information tonight. So, as far as the 401k and the IRA investing is concerned, Dimitri is my go-to guy for solo 401ks and self-directed IRAs. Specifically, if I can send him more business for 401k and IRAs, I will as well, because he's a great businessman, and he's ethical, which is great. The 401k and the IRA are great tax-deferred investments. Again, the 401k and the IRA are great for tax deferral investment accounts, meaning the money that you're putting into those accounts more likely than not is being invested in mutual funds or stock funds, and it's playing the market. Whereas a self-directed IRA and a solo 401k are basically checkbook controlled retirement accounts, meaning that I can actually purchase property within these retirement accounts, whereas a normal 401k and an IRA has the option of investing in the stock market. For self-directed IRAs, for solo 401ks, you have the option of taking, let's say that you have a couple $100,000 in your retirement account, you have the option of taking that money and purchasing property and having the cash flow from your rental investments fund your retirement, so that when you are ready to actually leave the workforce, you have an ongoing steady stream of income through investments that you know best. I am not a stock guy. I don't know currently what Apple's value of stock is. I have a smartphone that can tell me every 5 minutes if I want it to, but at the end of the day, I don't follow the stock market. I am a real estate guy. And I do know one thing before anything, and I grew up in a family of real estate investors, and that is that property will never be worth zero. Land and building will never be worth zero, whereas stock could potentially, a company could go belly up overnight and you could lose everything in the stock market. We've seen it before. I'm not saying that you should be afraid of investing in stock, but at the end of the day, I always suggest to my clients to go with what they know, to go with what they believe in, and I believe in property. And so the solo 401k and self-directed IRA are the modules that I choose to use, that a lot of my real estate clients choose to use. It's a very popular topic to speak on. In fact, we do seminars, Dimitri and I do seminars strictly directed at checkbook control accounts, such as the self-directed IRA and solo 401k. And the tax deferral investment opportunity is the same, whether it's the 401k IRA or the checkbook control accounts. When you put in, let's say, $17,500 is the maximum that you can put into a 401k for 2014. It is increasing in 2015 to $18,000. But let's say that I decide to put $17,500 into the 401k. It is fully tax deferred. So basically $17,500 of my hard-earned money this year is not paying a single dime of tax. The solo 401k works the same way. If I put $17,500 into my solo 401k, it is fully tax deferred. So it should not show up in either your W-2 income as being taxable wages, or if you're a sole proprietor, the 17.5, or you can actually do a calculation if you're a self-employed individual, it's 25% of your net profit that you could put into the retirement account, self-directed IRA or the solo 401k. And so the contribution limitations may differ based on the account. At the end of the day, your accountant should be putting you in contact with somebody like Dimitri, who can walk you through the steps of setting it up. And then Dimitri will toss you back over to the tax advisor to walk you through the tax savings that you're going to receive by investing in these types of accounts. Remember, going back to when we first started the webinar tonight, you have to have these accounts set up before December 31st and get them ready to be funded. Once again, you don't really have to fund a lot of the investments until April 15th. The sooner you fund it, the better off, because you don't want to push it off and procrastinate. I've had clients push off $50,000 deferrals until October 15th, and all of a sudden, because they're real estate people, they don't have the $50,000 anymore because they've put it into property. And now we have to amend the return, take the $50,000 write-off off, and then that increases their tax liability plus penalties and interest. So that's not something that you want to get caught up in. You want to defer that money into the account as soon as possible. And it's all the power of planning, the power of organization. We have a saying here called POP, and it's a little bit cheesy, but I love it because it stands for power of planning. And the power of planning, people don't understand how much tax you can really save and how much of a reduction in potential for audit you can have if you just plan ahead. And a lot of people who are out there who are self-employed, who are working and who have families, children, and spouses that they take care of, or parents that they take care of, a lot of times they don't have the time to sit down with their accountant. But your accountant should be good enough to where if the numbers, if you're on the phone with your accountant, you're saying, well, you know what, I think I made a little bit more income this year, maybe $15,000 more in profit. Can you run the numbers on that? Your accountant should be able to crunch that within 10 or 15 minutes to make sure that you get those numbers in before December 31st. I remember a couple of years back, I sent a client to Dimitri to set up a 401k, and I think that he was working on December 30th trying to set that up for my client, and you know, that ended up sheltering quite a bit of money for my client, and he was very, very happy. So you know, having this team of investors, having a tax preparer that you trust, that is knowledgeable, that is up to date with the code. Many of you may still be with an accountant that you've been with for 30, 40 plus years. Bob Hall's been in the business for 43 years. We have clients who were his first clients when he worked out of a garage here in Glendale. Now we're in a 3-story building. So we know that you get comfortable with these accountants, but if they aren't understanding of the type of business or the type of industry that you work in, you could be leaving a lot of money on the table. And Uncle Sam will not go out of his way to tell you that you're overpaying him, essentially. He's not going to teach you how to structure your investment. So it's very important for you all to take interest in this before December 31st. Now we have, 28 days left or 29 days left in the year, and you have plenty of time to pick up the phone and give your preparer a call and sit down with him or her and figure out how to shelter as much money as possible, because that's the only way that you can effectively pay your obligated amount of tax and not a penny more than that obligated amount. So I throw up this picture at the end of every seminar that I give because, you know, a lot of the tax information is a little bit overwhelming, and that is not a picture of me. I wish it was, but that is not me. It's actually a pretty good picture, and it's kind of self-explanatory. A lot of people do like to bury their head in the sand after talking about taxes, or, you know, they might not even want to talk about it at all. You all here in this webinar have showed up and listened to what Dimitri and I have had to say. We appreciate that, you know, your attendance. Dimitri's Sense Financial offers free consultations. Same with Robert Hall and Associates. We offer free 30-minute complimentary in-person or over-the-phone consultations. So I see somebody who lives in Pasadena. You're right around the corner from us. So if you would like to take advantage of this free consultation, all you have to do is either swing by the office and pick one of these up, or what you can do is you can call the number on the very far left part, and I know it's on the side, or you can visit our website, roberthalltaxes.com. Our phone number is 818-242-4888. And we do, once again, offer free consultations. Lydia is the marketing coordinator. She'll go ahead and set you up with that free consultation. And I think that I'm going to toss it back to Dimitri really quick and possibly answer any questions that you may have. If you have to leave and you want to contact either of us later on, it's either tomorrow or if you want to, you know, contact us at a later time, that would be great. And I'm getting a little message. This is the first time I've been using this program as well. So let's do questions. Let me just see something really quick here. And if I can just do...
Tony, let me just pass on some questions over to you.
Sure.
And guys, if you have any questions for Tony, please go ahead and type them in the chat area so I can read them and ask them Tony while he's still here. We only have a few minutes left before we have to wrap this up, but we do have a few minutes that you can go ahead and ask the questions. Tony, can you talk about oh, you did talk about the mortgage deductions. Okay, you did talk about this. Mm-hmm. Hold on. So if you can cover something else, and let me just pull some questions here, and I'll read them for you.
Sure. So a lot of the questions that I get to around this time is whether or not people have their assets protected in the best way possible. So one of the seminars that I do give is the power of incorporating. For a lot of the real estate investors out there, people who are in the webinar tonight who actually own property, whether it's a residential property or a commercial property, anybody who owns investment property needs to consider having some sort of asset protected entity structured around that property. LLCs, for instance, your options are between LLCs, S corps and C corps, and there's LLPs and LPs, but the main one that I want to focus on for investment property is the limited liability company. The LLC is a great entity structure. It does exactly what its name entails. It limits personal liability, limited liability protection entity. that is the only entity that you would want to use for protecting large depreciable assets. And so LLC should be good for acquiring title to property. S corps are great for small businesses, both product and service. And the C corporation is good for larger corporations who are needing 100 shareholders or more, so on and so forth. So I do have a question here from Rick. Please explain how to prepay tax on the solo 401k contribution so that profits from the contribution will not be taxable in the future. So at that point, Dimitri, and you can chime in whenever you want, at that point you would need a Roth account, not the normal solo 401k account. You would need some sort of Roth module, because the Roth, R-O-T-H, I'll spell it out for people if the microphone isn't coming through, Roth account allows you to prepay tax on your tax return. So let's say that I made $50,000 in self-employed income this year. I want to put 25% of my $50,000 of net profit into my Roth account. Well, at that point, 25% of $50,000 is $12,500. So if I put $12,500 into my Roth, on my individual tax return, I am still paying tax on that $12,500. It is not a tax write-off for me. But the $12,500 goes into the Roth account, which can then be used to either flip or invest in long-term investments. And once you start to liquidate money from that Roth account, that's when you will actually pay tax, or not pay tax on it. You're paying tax on that money before it's even going into the Roth account. And so the exact opposite is true for the traditional 401k or solo 401k, whereas you are putting money into the account before it's ever paid tax. So to explain how to prepay tax, it's just basically paid through your individual tax return, through either estimated tax payments or through withholding from a W-2. And that's essentially how you can fund your Roth account. You take whatever individual money you want. Let's say you're putting 17.5 into the Roth 401k. You put that 17.5 in there. You've already paid the tax on the 17.5 individually on your 1040 tax return, and that money's going into the account as already being taxed. And so that's essentially how you prepay the tax on the solo 401k contribution, Rick.
Okay, great. And let me just add a little bit or comment a little bit more. So using the example that Tony, you used, let's say you own a business and it's a S Corp and you're paying yourself salary, and let's say your salary for the year was $50,000 in this example. Actually, the contributions to Roth 401k considered to be salary deferral, and that the limit on that is $17,500, right, regardless of your income, up to 100% of your earnings. So again, if your income is $50,000, you can put $17,500 into Roth, and then if you're over 50, you can do additional $5,500 up to $23,000. And then on top of that, your business can also do additional profit sharing contribution of 25% of your compensation, but that has to go into pre-tax. So again, back to a question from Rick. When you receive a paycheck for $50,000, you're paying taxes on that amount, but then you taking $17,500 from the amount that you already paid taxes on. That goes into your 401k, Roth 401k bucket, and you will never be taxed on that again. Okay, Tony, I do have another question here, and when should I incorporate to set up an LLC? I have a small side business while having a full-time job, and will it save me on taxes?
So as far as an LLC is concerned, an LLC is not going to save you tax. An LLC is only going to be an asset protection entity. The LLC is great for small business protection. However, if you are working a W-2 wage earning job and you have a small side business, I wouldn't necessarily incorporate you until your net profit was something substantial, maybe somewhere around $10,000 or $15,000. And once again, it really all depends. The conversation that I normally have with my clients goes something like this. I'll ask them probably around 3 questions. One would be, what personal assets do you have that need protection separately from this business that you're trying to put in your LLC? Well, if you tell me that you own your primary residence, if you tell me that you have money in your 401k, if you tell me that you have inheritance that coming in from a family member, so on and so forth, then you may want to incorporate as an LLC strictly to protect those individual assets separately from your business that you're operating at. However, if you don't have the 401k, if you don't have the home, if you don't own the cars that you drive and you lease, if you don't own any assets, incorporating for asset protection really isn't going to give you any benefit because you can't squeeze juice from a turnip. So at that point, the LLC really needs to be put in place if you need personal assets protected separately from your business. So that's the first question, is what do you own personally as assets? Number two would be, what is your net profit? And along with that is, what industry are you working in? So if you tell me that you're in real estate and you're selling property and you're a commission-based sales rep and you're making $50,000 net profit, meaning that after all of your expenses are taken into account, you have $50,000 in profit. At that point, I may incorporate you as an LLC with what's called an S election, where you elect to be taxed as an S corporation for the tax benefit. Because once again, out of all three entities, I don't think I've said this yet, but out of all three entities that we essentially are discussing, the LLC, the S Corp, and the C Corp, the only entity that can actually save you tax is the S Corp. The LLC is strictly for asset protection. The C Corp is for asset protection, but also for large million, if not billion-dollar corporations with 100 shareholders or more. And the S Corp is a hybrid. So the S corporation gives you that added layer of asset protection of an incorporated entity while giving you all of the corporate benefits of corporate America. And the S corporation, when I call it a hybrid, I mean that it's kind of like a C corp and an LLC combined. The money that you make through the S corp is not taxed at the corporate level. It is all a flow-through tax liability, which, let's say that my net profit once again is $50,000. I'm not paying tax at the corporate level on $50,000. I'm reporting that $50,000 of profit on my individual tax return. And so the LLC is great for, once again, businesses that have large depreciable assets, but the only entity that you'd ever want to consider for tax savings is the S Corp. And unless your net profit is above $50,000, the expenses of filing an S Corp are probably going to be much greater than what it actually saves you in tax. And once again, unless your net profit is above $50,000. And the third question I ask after I find out whether or not they own personal assets and how much profit they're making, I normally don't get to the third question, but I ask my clients, what kind of risk and liability do you operate in your industry at any given time? And you know, I always use this example. If you have, you know, if you're an attorney, for instance, and you're a contract attorney drawing up a contract between party A and party B, and party A is selling a business for $1 million to party B, the person most at risk in that transaction is the attorney, because he's the one drawing up the contract between party A and party B. Well, if the deal falls through or goes south, both party A and party B are going to look to the attorney and say, hey, listen, you drew up the contract. The reason why we lost money in escrow is because of your mistake on the contract. And so at that point, most attorneys will either be LLPs or LPs for asset protection or for individual protection to keep their business practices safe from any other investments that they may acquire in future years. So once again, it's very, very specific situations that you need to talk with your accountant about, or talk with Sense Financial about, to make sure that you're set up in the right way. You know, you'll go to a lot of free seminars, you know, and some webinars as well. I've been to a couple free ones myself and not told anybody that I was a tax guy. And I've been approached by people who are pitching this benefit of incorporating. And a lot of people will just tell you that if you're self-employed, you should be a corporation. And that is not the case. You know, an accountant can charge you more for a corporation. There's more paperwork that has to be filed, more organization, more correspondence. In certain states, there's more tax liability because of a corporation, certain filing fees that need to go along with the corporate entity. So you need to make sure that you know everything about that before you hop into an investment. Attorneys will charge thousands of dollars to incorporate you when you don't even need the incorporated entity. And so these questions that I've given you tonight in regards to whether or not it's the right time for you to incorporate, these are very important questions that you all need to be asked. So you just need to make sure that you're in the right hands and that you're being asked these very important questions. So back to you.
Thank you, Tony. Thank you. And last question we have is, can you do my taxes if I reside outside of California?
Oh, absolutely. So Robert Hall Associates does taxes in all 50 states. And like I said, we've been around since 1971, been around for 43, going on 44 years. You know, and we pride ourselves in being flexible. Flexible meaning that we can do tax returns over the phone, we can do tax returns in person, we can do tax returns by Skype, we can do tax returns if you want by microphone and webinar. I mean, at that point, we're just trying to make ourselves easy to access to our clients. And like I said, we filed just shy of about 10,000 filings per year, and not a majority of them, but quite a few of them are outside of the Los Angeles area. We have quite a few clients in the Northern California area around the San Francisco Bay Area. And then we also have clients branching all the way out to New York and Florida, some in Texas, Wisconsin, Wyoming, Delaware, obviously for the asset protection benefits that our clients have, anywhere upwards of Alaska and Oregon. So we do taxes in all 50 states, which is, it makes us very worldly, so to speak, in our tax knowledge. And I'm not going to pretend to know everything. I know quite a bit about the tax code, but if I don't have an answer for you, I am one of those guys and my associates, the 13 other accountants that work at Robert Hall. We are very good at researching topics, and we're very good at accessing information and getting that information to you. So if you ever have any questions, you can always feel free to pick up the phone and give us a call. The most formal way of getting in contact with a preparer, especially if it's during tax season, because we're with clients every hour on the hour, Monday through Saturday, is to schedule this free consultation over the phone. That way we can get your answers to you. You shoot an email to the accountant beforehand with all of your questions. The accountant picks up the phone, and within 30 minutes, I know that a lot of you may be thinking, well, what can I get answered in 30 minutes? You would be very, very surprised at how much information we can relay to our clients if we're only given 30 minutes and a phone. Once again, that's something that I pride myself in. That's something that a lot of my associates pride themselves in. And I'm sure that Dimitri prides himself in that as well, because he is a wealth of knowledge when it comes to solo 401k investing.
Okay, great. Thank you, Tony, again for joining us. Our time is up. Thank you, everybody, for joining. I just sent you a quick message here in the chat, the form that you can actually click on this link, and you can go directly to the form and request free consultation with one of the tax experts. So thank you for joining us, and you guys have a great evening. And I hope you do the right thing and make some adjustments that will benefit you for the tax year.
Thank you.